Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 2, Academic Theory, Issue Number 9, The Capital Asset Pricing Model. The efficient market hypothesis durability is due largely to the development of the capital asset pricing model, or CAPM. Derived from Markowitz's work, the CAPM determines the return on an asset added to a well-diversified portfolio. Expected return equals risk-free rate plus alpha plus beta, where beta is the correlation between the asset's return and the market's return, defined as covariance, divided by variance. In efficient markets, alpha is considered to be zero. Although it is somewhat contradictory to the notion of efficient markets, a portfolio manager's performance is often measured in terms of alpha, or volatility-adjusted outperformance. In theory, a portfolio's beta accounts for its correlation to the market. Therefore, increasing return only by increasing volatility is not a reflection of the manager's skill. Remember, in EMH and CAPM, risk is defined as price volatility. CAPM has problems, such as price volatility does not determine risk, information is not homogeneous, investor behavior is not normally distributed, taxes and transaction costs exist. Generally, investors may not borrow and lend at risk-free rates. Investments are not infinitely divisible, and there is no clear definition for the market. Empirical observations do not support the predictions of this model. The Fama-French three-factor model makes adjustments based on an investment's market capitalization, under the assumption that smaller companies offer higher returns than larger companies, and price-to-book ratio, the value effect. The Carhart four-factor model adds an additional adjustment for price momentum. These adjustments are explained as other components of risk, in order to preserve the basic assumption that returns should be correlated to risk, in the absence of sensible explanation.